Well, this afternoon we've got Jacob Mitchell here with us. Welcome, Jacob. Now, you've been with Platinum, I think, for 14 years, and now you're the founding partner of Antipodes Global Investment Partners. Do you want to tell us a little bit about the difference between Platinum and what you're doing now with Antipodes?
Thanks, Ian. At Antipodes Partners, we describe ourselves as a pragmatic value investor. That means we're looking to buy great businesses, but also at a great price. Now, the problem is the market typically is aware of what a great business is, and so it doesn't often become cheap in the market. So when that happens, it's typically around changes in the operating environment that business faces. Cyclical change at one end, structural change at the other end, and it's a continuum. And there's also socio-macroeconomic change that impacts business. When markets become irrational around the longer term impacts of that change is when you get the opportunity as a pragmatic value investor to buy a company with a margin of safety, with multiple ways of winning. Now, it's not good enough just to buy great individual companies. You have to think about how the portfolio works in totality. So we call that non-correlated sources of alpha. We want to buy 30 to 50 great ideas that work well as a portfolio. If we do that well, we'll deliver absolute returns ahead of the benchmark over the investment cycle of 3 to 5 years. Now, the good thing is we can also express that long, short, and also with currency management.
Do you have any geographic limits that you set yourself, or does that not concern you?
We're in no way constrained by a benchmark. We invest where we see the opportunities. And however, in terms of that non-correlated sources of alpha, we are aware of where concentrations of risk are building up in the portfolio, which is more than just geographic exposure. It's also end market, factor exposure, other ways of thinking about risk. They're the limits that we enforce on ourselves rather than just benchmark geographic limits.
You're a global fund, and we're sitting down here in New Zealand, way down here in the Pacific. Now, the reality is we've been very isolated, and that's been a negative for a long time, but it appears as though it's becoming a bit of an advantage. Look at the New Zealand economy. It's doing well. We've got positive population growth. We've got low unemployment. We've got export growth. And we've got fantastic growth in our tourism, just record numbers. So the question is, why does a New Zealand investor look to invest away from that backdrop?
Clearly the opportunity to more broadly in global markets to gain exposure to industries that are not available here locally. And secondly, it's just the diversification benefit of being able to gain exposure to non-New Zealand assets. Whether you want that's sort of a different question. I think people going beyond the obvious, if you think about Australia and New Zealand, a lot of our economic outcomes are correlated to China and Asia. So it's thinking about the context of that risk. But I think you're right. I mean, both the Australian and the New Zealand economies have shown a degree of flexibility, and part of that has been the benefits of a weaker currency that has surprised many.
When you look at the portfolio and you look at where you're investing, where do you see, when you're balancing risk versus reward, where's the big opportunities at the moment?
So clearly there's a bias being expressed in the market around certainty, and people express that the desire for buying growth or profits because the perception is we're in a low growth environment. We think that's going to hang around for the foreseeable future, that bias. However, rather than being focused on top line growth, that's proving to be more and more elusive. We think investors should focus on pricing power. Invest in companies by virtue of their uniqueness and their market structures that have pricing power. Now, it doesn't mean they don't necessarily have to be defensive businesses. Some of the more cyclical businesses in the world, by virtue of the fact that the industries have gone through shakeouts, where the leaders are emerging more strongly, actually have the greatest latent pricing power. I think if you take the example of our biggest holding, Samsung Electronics, it's number one in memory semiconductors globally. Very consolidated sector. It is where the cloud starts. I mean, cheap solid state memory is what is enabling what we know as cloud computing and the Internet of Things. It starts with Samsung, and its leadership in that space is getting longer. And so we think that's a great example of a company that's trading at its global financial crisis low valuation that has a lot of latent pricing power.
Recently, we've seen countries around the world go to negative interest rates, and most recently Japan.
Sure.
What sort of impact do you think that'll have on markets, and do you think that the initiatives taken by these central governments is going to see them through it?
I think negative rates is just highlighting some of the natural limits around monetary policy. There hasn't been a great, let's call it, market reaction to negative rates in Japan or Europe. When you look at what central banks can do versus what governments can do, ultimately governments could do a lot more on the reform front. Abenomics had left all the hard decisions really on the table around labour market reforms, reforms to encourage domestic M&A activity in Japan, and it is often a crisis that brings out some of that brings out the necessary, if you like, incentives to do some of these hard decisions. So sometimes I think the central banks that make it, longer term policies are a little bit counterproductive, and they're possibly sending the wrong price signals to business constituents. We are struggling to get a capital spending cycle going in the developed world, and central banks cutting rates really hasn't had the intended effects in some ways.
It's been a short-term solution and maybe not the long-term solution you're looking for, which sort of brings me to a natural question now that touches on politics interfering with markets, if you like. We have a couple of major issues globally at the moment politically. We've got an election coming up in America where it looks like we could have Donald Trump versus Hillary Clinton. What do you think that means for markets? Is that something that concerns you, or do you think the markets will say that's a sideshow, doesn't matter?
I suspect it's some of the media outlets are rubbing their hands thinking about the great content that's going to be generated by this. Sure. But from a market perspective, I think it is indicator of a longer term concern, which is just the polarization that has taken place in politics. There's a general sense of disenchantment across the electorate, which is a little bit bizarre when you think about how well the US economy is doing. And a part of that, I think, just reflects this longer term, let's call it, changing of the pie, where corporates have done very well, but labour's share of the pie has shrunk. As a percentage of GDP over the last 50 odd years, it's shrunk by close to 10%. So that's, I think, the sense of disenchantment. Broadly, the population doesn't feel like they're participating in the economic success of the country, and then it gets expressed in this very polarised view of what's good for America, where the middle is not really represented. And I think that's bad, ultimately not a great outcome for markets.
Yeah, and I suspect to add to that, we've got something called social media, which is so much easier these days for everybody to have their view. And move from there and go a little bit further up. What about Brexit?
Look, that's a tricky one to sort of call. I mean, we know what the polls are suggesting, and it's very close. My sense is that the average voter will blink and it's easier to stay than go. But I'm not going to make that call. I would just say that there's opportunities and there's risks. I think the opportunities are that a lot of the obvious de-risking has meant that people have sold good businesses for the wrong reasons. So there's selective opportunities, especially in Europe, around some of the banks that are very cheap versus the franchise that you are able to buy. I think ING is a good example of that. And then in terms of hedging your risks around Brexit. Once again, I think it's easier it's going to pay off in the longer term by hedging those risks in the second order exposures. So we've studied the high yield market in a lot of detail, and we think generally a lot of the very leveraged, more cyclical businesses that have taken on leverage to grow in the US and in Europe are not priced for any of the Brexit risk, because clearly it would be a risk for global markets, not just European markets.
For investors out there, where do you see the next wave of potentially good news?
Look, there's some big, obviously the longer term growth trends around emerging, whether it's the emerging middle class, the fact that technology is is lowering the barrier to entry for to the modern globalized economy, in not just in an obvious emerging markets, but just access to information and the speed at which innovation is taking place. If you can benefit from that and without overpaying, then that's a big long-term story. We think the surprise will be, in terms of a cyclical recovery. There's a lot of some of the more developed parts of the world, like Korea, let's call it the developed end of emerging markets, where they have flexibility to cut rates. I mean, Korea is one of the few places in the world which has, policy rates of approximately 1.8%. That means they have flexibility to cut. In other parts of the world, we already know they're negative. So we would argue there's flexibility there to stimulate their economy, and that's not being priced into the equity markets. So be selective. Growth, there's clear growth trends that you want to be exposed to if you can buy them at the right price.
You clearly have a pretty good handle on what's going on, and we're very, very impressed with the performance that you managed to egg out when you were your 14 years with Platinum. But maybe you'd just like to tell us a little bit about the team that you've brought with you at Antipodes, because I understand the team, it is partners, and there is more than just Jacob Mitchell in the team.
That's right. We have a team of 9 senior investment analysts, and the way we structure the team is with one portfolio management team supported by the analysts. We put portfolio construction at the centre of what we do. We're delighted to have a little bit of, let's call it, genetic diversity in the team, and on average, we counted it up the other day. In total, there's just over 100 years of global investment experience across the team.
And on top of that, you're supported by using Pinnacle as the administrator for the fund. Is that correct?
That's right. So Pinnacle bring a lot of distribution, bring all of our distribution support and all of our infrastructure support. So that's your back office, it's all of your financial accounting support, compliance support. All those mission critical functions are in a safe and experienced set of hands at Pinnacle.
Well, maybe that's where you should be looking for your growth, mate. Go look for somewhere like compliance. I'm sure that's going to be a growth industry that you could do very well out of, finding compliance companies and go with that. But thank you, Jacob, for that, and we look forward here at SAG to support Antipodes, and we look forward to having you here in the future. Thank you very much.
Excellent. Thanks, Ian.